Hello, my name is John Homan, and for my policy exploration project, I decided to look at the Federal Reserve's monetary policy, more importantly, their interest rates, effect on private savings and consumption. The reason I decided to choose this one was because of the interest rate cut that happened earlier in March because of the coronavirus pandemic, and I wanted to see the kinds of effects that it might have on the economy going forward. So, just to give a little background information on the Federal Reserve, they're the central bank for the United States, and it was created on December 23rd, 1913, with the enactment of the Federal Reserve Act. And the Federal Reserve is arguably the most powerful financial institution in the world. So, what does the Federal Reserve do? What's the purpose of the central bank? Well, there's five main functions of the Federal Reserve. The first is conduct monetary policy. They do this by printing money or buying government bonds or other kinds of credit. They increase stability of the financial markets. They want to minimize the risk in the U.S. for our finance markets. They don't want people going broke or making tons of money randomly. They want to promote and monitor financial institutions and their impact on the economy. They also foster payment and settlement services to the U.S. banks and government. And lastly, they promote consumer protection through economic analysis and research because the Federal Reserve wants to know what they're doing and not mess anything up. By far and away, the biggest impact that the central bank has on the economy in the U.S. is their monetary policy. And their monetary policy involves the central bank's actions that manage the money supply. This involves forms of credit, cash, checks, and money market mutual funds. The main three objectives of monetary policy are controlling inflation, which you want to keep around 2%, managing employment levels, which you don't want to be too low, and you want to maintain long-term interest rates. The reason the Federal Reserve does this is because they want to influence production, prices, demand, and employment so that they all work together and create a strong, growing economy that's good for the consumers. So the main thing I'm focusing on with this policy exploration is the effect of interest rates on consumption and saving. So interest rates are pretty much the rate a bank or other lender charges to borrow its money, or the rate a bank pays its savers to keep money in an account. That would be if there was a negative interest rate. When the Fed practices expansionary monetary policy, they increase the money supply, which lowers interest rates and increases demand. And when the Fed practices contractionary monetary policy, they decrease the money supply, which increases the interest rates normally and decreases demand. So you might be asking, why is the central bank important? Why are these interest rates important? Well, generally, changes in the interest rates have a huge effect on the economy and how consumers act. They influence the cost of borrowing, the return on savings, and an important component of the total return of many investments. If interest rates are too high, this can cause deflation and slow or halt the growth of the economy. If they're too low, we will experience inflation, making the value of our currency and our economy as a whole weaker. So, why is this important in terms of saving and consumption? Well, generally speaking, when interest rates are high, people will save more and consume less. And when interest rates are low, people will save less and consume more. So, as you can see in the graphs below, an increase in the real interest rate leads to an increase in savings. And when people save more money, they have less to use for consumption. And by saving money when interest rates are high, you'll have more money for consumption later. So I wanted to see how the Federal Reserve's monetary policy affected saving and consumption in 2008 when they decided to cut rates. And it says right here, in December 2008, the Federal Reserve reduced the federal funds rate to zero in order to provide stimulus to household and business spending and to support economic recovery. In the graph here, you can see that the federal funds rate was generally around 5, and they were increasing it between 2004 and 2007. But when too many subprime mortgage loans were being handed out, banks got crushed, and the Federal Reserve decided that they had to step in and they decreased the federal funds rate pretty much all the way down to zero. So when they decided to cut the federal funds rate down to pretty much zero in December of 2008, I wanted to see the effect that it had on the personal savings rate shortly after. And as you can see, you can tell when the Fed decided to cut their rates because the personal savings rate went from 6.4% all the way down to around 5.6%. So then I decided to look at the personal consumption expenditure after the Fed decided to cut rates. And as you can see here, the graph starts in December when they cut rates to zero. Personal expenditure was around $9.72 trillion. And after they cut the interest rates, personal expenditure in January went all the way up to $9.78 trillion. This consumption didn't last very long, though, because the markets and the economy were still going down, and they pretty much bottomed in March of 2009. And as you can see in the graph, consumption then recovered and grew from there. So after looking at an interest rate cut in 2008, I wanted to see what an interest rate hike did to personal saving and consumption. So I looked in the Federal Reserve data and did some research online, and I saw that interest rates were very high around the late 1970s and 80s. And I found out that after President Nixon disengaged the dollar from the gold standard, inflation almost tripled from 4.6% to 12.3% in December of 1974. So the Fed decided to double their interest rates from 5.75% to a high of 11%, and inflation continued to remain in double digits through April 1975. Inflation was getting so bad that in 1980, the Federal Reserve decided to raise interest rates, which reached as high as 20% in order to combat double-digit inflation. But this ended up causing the 1980 recession, but it did end double-digit inflation. So as you can see here, in December 1974, our currency didn't go by the gold standard anymore, and inflation started to go up. Well, they decided to increase the interest rates, and while personal saving did go down between January and February, it started to climb up a lot in March because the interest rates were getting pretty high. So with higher interest rates and saving going up, I was expecting to see consumption to go down. But in 1974, you can see that personal consumption expenditures continue to rise even in recession. So that was a little surprising to me. I would primarily attribute personal consumption going up to just how strong the American economy was and how we've always been able to get through any kind of recession or depression. So, after looking at the Federal Reserve's interest rate cut in 2008 and their interest rate hikes in the 1970s, I decided to look at some current Federal Reserve monetary policy and see what they're doing during this pandemic and how it might affect our country and economy. So back in March, the Federal Reserve decided to cut interest rates and keep them around zero until the economy got back on its feet again. The Fed wanted to see employment go back up and for inflation to maintain a rate of around 2%. There have been rumors that the Fed wanted to offer negative interest rates. However, the head of the Fed, Jerome Powell, says that that was unnecessary. So while these interest rate cuts happened back in March, I believe that it's a little too early to see the effect the interest rates will have over the next year. But according to interest rate cuts, the economy should expect to see an increase in consumption over the next year. I would also infer that there will be a decrease in saving due to the cut of the interest rate over the next year. And at the moment, this isn't really the case. And it's most likely due, or it definitely is likely, due to the government shutdown and economic shutdown. So I decided to pull up some graphs of personal consumption expenditure and personal saving. And these are graphs of just 2020 so far. But as you can see, even though the Fed did cut rates pretty much down to zero, consumption has decreased tremendously. and it's the exact opposite for personal saving. Um, when the Fed decided to drop interest rates, people were still scared and didn't want to spend, so people decided to save more because of the uncertain times that we're in. So you might be wondering, what's the trade-off of these interest rate cuts? Well, some pros are that the borrowing becomes cheaper, making large purchases on credit more affordable, such as home mortgages, auto loans, and credit card expenses. Also, it increases inflation. Currently, our inflation is around 0.3%. We want to boost that way up and try and get it to 2%. And it also stimulates economic growth. There are also some cons that come with the interest rate cuts. Inflation could suddenly rise too high later and make our currency and economy a little less valuable. And then also, it could create a liquidity trap. And with interest rates near zero, the Federal Reserve may have to resort to offering negative interest rates, which isn't very good for our country and their current debt. So overall, it was pretty cool looking at uh, what monetary policy and more importantly the interest rates, how they affected consumers' private saving and consumption. But as you can see here, I just want to go over the Federal Reserve is arguably the most powerful financial institution in the world. Their three objectives are controlling inflation, managing employment levels, and maintaining long-term interest rates. Changes in interest rates have a huge effect on the economy and how consumers act, and interest rates have a large effect on saving, but not really as much on consumption, from what I found.